Hi there, I'm Dr. Victoria Clout, and I'm here to explain some accounting. In this video, I'm explaining how to account for bonds for a company. Bonds are a liability of this company that we're looking at, and it's a way of raising funds. So bonds, you can think about being a kind of an agreement. It has certain terms and conditions like a coupon payment, interest rates, and a time in which the bond will be repaid in full. So it's a way of raising some money. The bond can be subsequently traded on the market as well. So let's take a look at how to account for bonds. So I'll put a link into the description of this video for the template and also the solution so you can follow along. At the beginning of 2008, Heat Seeker Limited issued 200 of $1,000 bonds with a coupon rate of 7.3%. This is paid annually in arrears to the bondholders. The bonds have 4-year maturity, and the question says that the bonds were not very well received by the market, so they received only $860 for each of the bonds. This suggests that there's an effective interest rate of 11.9%. So we're going to prepare the journal entries to record for the issue of the bond and the payment of the interest and the coupon rate. So the first journal entry we're asked to record is to write down the journal entries to record the bond issue at the beginning of 2008. So we're going to debit cash. This is based on the amount of cash that we actually receive from the market. So for those 200 bonds, we received only $860 each. So 200 multiplied by 860, this gives us cash we received of $172,000. We're going to leave a line and then we're going to credit bond payable. This is based on the face value of the bonds. So 200 multiplied by their face value, which is 1,000. So we credit bonds payable for 200,000, the face value of the bonds. So in the middle of the journal entry, we're going to debit bond discount. So the bonds were issued at below their face value. So the bond discount we calculate as the difference between the face value, 200,000, minus the cash we received of 172,000. So we're going to debit bond discount 28,000. The bond discount account is a contra liability. So it's debit natured, and it acts to reduce the bond payable because we did not receive the face value 200,000. So the bonds in our balance sheet would be recorded at a net amount of the bond payable minus bond discount, and that net amount is 172,000. Part B, we're asked for the year ending 2008, what would be the journal entry recorded? So we're going to have debit interest expense, where the interest expense is based on the market rate of 11.9%, and we're going to multiply that by the carrying amount of the bond. The carrying amount being the difference between the face value, 200,000, minus the bond discount, 28,000, and so equal to what cash we received. So we received 172,000. So 11.9% multiplied by 172,000 gives us interest expense of 20,468. So that's what we debit interest expense for. We're going to credit bond discount. So we're amortizing away the bond discount. We'll leave the amount blank for now. We're going to calculate that a bit later. We're going to credit cash. Cash is credited for the coupon payment. So that's based on the coupon rate of the bond, 7.3%, multiplied by the face value, 200,000. So the coupon payment is 14,600. So we credit cash for 14,600. Now we can come back to the amount we want to calculate for the bond discount amortization. This is going to be the coupon payment, 14,600, minus the interest expense, 20,468.
$5,468. So we calculate the missing amount for bond discount to be $5,868. So part C of the question asked us for the year ended 2009, what would be the journal entry? So once again, we're going to debit interest expense. This is going to be calculated based on the carrying amount. So the carrying amount, we start off with the initial amount of cash we received of $172,000. Now we're going to add on the amount of bond discount that we amortized away, because that's now reduced by $5,868. So our new carrying amount of our bond is $177,868. So we calculate our interest expense based on this new carrying amount, multiplied by 11.9%. This gives us interest expense of $21,166.29. We're going to credit the bond discount, and we leave the amount blank for now. Credit cash, this is equal to the coupon payment, is the same every year, so $14,600. So we calculate the bond discount as that interest expense, $21,166.29, minus the coupon payment, $14,600. This gives us a bond discount amortization amount of $6,566.29. So we've recorded the journal entry for 2009. So part D, we're asked for the year ended 2010, what would be the journal entry? So we set it up as previously. We're going to debit interest expense. We're calculating interest expense based on that carrying amount. So we have the carrying amount from the previous year of $177,868, plus the additional amount that we amortized away of the bond discount from the previous journal entry, $6,566.29. This gives us a carrying amount of $184,434.29. So the interest expense, we calculate that out as our carrying amount we've just estimated, multiplied by 11.9%. So the interest expense will be $21,947.68. So we can put that in as the debit interest expense. We credit bond discount, leave the amount blank for now. Then credit cash, $14,600. So to calculate the amount of the bond discount that we amortized, we take that interest expense, $21,946.68, and minus the coupon payment, $14,600. So we're going to credit bond discount, $7,347.68. We now come along to part E. So for the year ending 2011, what would be the journal entry? So we're going to have a journal entry to record that final interest expense, coupon payment, and also to close off the bond payable, we have a final payment journal entry. So debit interest expense, so it's equal to that carrying amount multiplied by the market rate of 11.9%. So we estimate our carrying amount. We take the carrying amount from the previous question, and we're going to add that additional amortization from the previous year. So this gives us a new carrying amount of $191,781.94. Multiply that by the interest expense percentage of 11.9%, our market rate. This gives us interest expense $22,818.02. Credit bond discount, leave the amount blank for now. Credit cash, $14,600, that coupon payment. And now we're going to take the difference between the interest expense, $22,818.02, minus that coupon payment, $14,600. And we're going to put in then our credit amortization to bond discount, $8,218.02. What we're going to have now is a final journal entry to record the payment. So we're going to pay the bondholders the original face value of the bond. So to close off this bond liability, we debit bond payable 200,000 and we credit cash 200,000. And we've repaid to the bondholders the face value of the bonds.